In defense of high-frequency trading, after last week's sell-off, it might feel a bit like spitting into the wind, but Michael Durbin says high-frequency trading does us more harm than it does bad. Michael helped to develop trading systems at Citadel Investment Group and Blue Capital, and he is, from time to time, an adjunct professor at Duke University's Fuqua School of Business, and he is the author of All About High-Frequency Trading, which is due out in August. He is with us this morning. Michael, let's start with this. We've already heard from some lawmakers who want to use Thursday's meltdown as a reason to ban high-frequency trading. Does it bear any responsibility for what we saw?
High-frequency trading in general does not. It's just a misconception that HFT is entirely responsible for this. HFT just refers to the speeding up of the markets we have these days, and that's just inevitable. There are certain aspects of HFT that absolutely need attention, starting with what we've talked about already. We do need market-wide controls. Holding the NYSE responsible for checking these crashes is just unrealistic. They don't have their hands on enough of the market enough to do that anymore. So starting with those kinds of reforms, but HFT overall, no, that's just painting with too broad of a brush.
All right, let's talk a bit about the NYSE, because there has been this debate over market structure. It is very technical. Have we gotten to the point where trading platforms like dark pools, like Goldman Sachs, Sigma X, or Crossfinder from Credit Suisse actually bear more of the responsibility, if not those two specific platforms themselves? In general, maybe they're the ones at fault here and not the New York Stock Exchange.
Well, we'll see who's at fault soon enough. The data is there. I mean, right now investigators are combing over all this black box data, if you will. It's not particularly easy for them to get to, but it is there. We will find out within the next few days exactly what happened, because every quote, every order, every trade, it's there. And I don't think we're going to find any individual pool totally responsible. But I think we're just going to have to accept the fact that there's this massive fragmentation in the market, and that everybody just has to play by the same rules. So I don't know that we're going to find one particular pool or not that's really at the heart of this. Maybe we will. I think we're more likely to find there are a small number of HFT algos that just started selling off like crazy. They had incompatible agendas, and it got out of control. And then, like I said before, the fact, well, let's put it this way: anyone who wants to have a real-time matching engine for trading, cash equities, options, futures, needs to be participating. For example, at a speedway, when there's a yellow flag, everybody has to stop. You can't just have a couple of cars slow down. If everyone doesn't respond to that yellow flag, you're going to have a crash one way or the other.
Okay, well, but on that subject, Steve Lutold of the Lutold Group, a buy and hold investor, told Bloomberg last week that the market needs speed limits. He said it's become a giant arbitrage operation. If that's the case, who's benefiting here if it isn't the people who are ultimately supposed to be served by the market?
Well, ultimately everybody who wants to trade at a good price is going to be benefited when markets narrow down, and that clearly has been been the result of HFT more and more. What you're seeing now is you're just seeing the replacement of the traditional NYSE specialists who did the same thing. I mean, they wanted to make the spread as well. Well, now there are far more people who are in a position to do that, and with that increased competition with electronics, you're going to see a narrowing of that. So I think that everybody ultimately is going to benefit from that. You're going to be able to trade at better prices, whether you're buying or selling. But we're doing it with these incredibly fast tools, and you've got so many people doing it. We need an industry-wide set of rules for responding to problem situations. We need much more transparency. I'm sure right now the investigators are scratching their, really struggling just getting to the data. We need more things like the SEC's large trader ID proposal. I think that all traders should be ID'd in every trade. I think we need that, and ultimately we're going to need standards for the quality of the software that's making all these real-time trading decisions.
Well, we'll see, Michael, if the SEC can use the meltdown as an excuse to get that from the exchanges when it meets with them today. That's Michael Durbin in defense of high-frequency trading.